Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Understanding Risk and Return. Understanding risk and return is a fundamental aspect of mastering business strategy and capital allocation. It involves analyzing how various investment options can impact the overall performance of a portfolio, given the potential risks and expected returns associated with each. This understanding is crucial for making informed decisions that maximize value while minimizing potential losses. Risk in capital allocation refers to the uncertainty surrounding the future returns on an investment. It is an inherent part of investing because the future is unpredictable. Risks can be categorized into systematic risks, which affect the entire market or economy, and unsystematic risks, which are specific to individual companies or industries. Systematic risks include factors such as economic recessions, political instability, and changes in interest rates. Unsystematic risks, on the other hand, pertain to company-specific issues like management decisions, product recalls, or competitive pressures. Return, in the context of investments, represents the gain or loss generated on an investment relative to the amount of money invested. Returns can be realized in the form of capital gains, dividends, or interest payments. The expected return of an investment is a critical measure for investors, as it indicates the potential profitability of an investment. The relationship between risk and return is often depicted as a trade-off, where higher potential returns are associated with higher levels of risk. One of the core principles in understanding risk and return is the efficient frontier, a concept derived from modern portfolio theory developed by Harry Markowitz. The efficient frontier represents a set of optimal portfolios that offer the highest expected return for a given level of risk. According to MPT, by diversifying investments across a range of assets, investors can reduce unsystematic risk and construct a portfolio that lies on the efficient frontier. This diversification is achieved through the careful selection of assets that have low or negative correlations with each other, thereby minimizing the overall portfolio risk. To illustrate the importance of diversification, consider the 2008 financial crisis. Investors who had concentrated their investments in the financial sector experienced significant losses as major financial institutions collapsed. In contrast, those who had diversified their portfolios across various sectors, including non-correlated assets like bonds and commodities, were better able to withstand the market downturn. This example highlights how diversification can mitigate risk and enhance the stability of investment returns. Another critical concept in understanding risk and return is the capital asset pricing model. The CAPM is used to determine the expected return of an asset based on its systematic risk, as measured by beta. Beta represents the sensitivity of an asset's returns to the overall market returns. A beta greater than 1 indicates that the asset is more volatile than the market, while a beta less than 1 signifies that the asset is less volatile. The CAPM formula is expressed as E equals RF ben RFs, where is the expected return of the asset, is the risk-free rate, is the beta of the asset, and is the expected return of the market. The CAPM provides a useful framework for evaluating whether an asset offers a fair return given its risk level. It is widely used by investors to assess the attractiveness of different investment opportunities. Despite its widespread use, the CAPM has limitations. It assumes that investors have homogeneous expectations and that markets are perfectly efficient, which may not always hold true in practice. Furthermore, the model relies on historical data to estimate beta, which may not accurately predict future performance. As a result, alternative models such as the FAMA French three-factor model have been developed to provide a more comprehensive analysis of asset returns. The FAMA French model incorporates additional factors such as size and value to better explain the variability in asset returns. Understanding risk and return also involves analyzing historical performance data to identify trends and patterns. For example, the historical average annual return of the S&P 500 index from 1926 to 2020 is approximately 10%, while the standard deviation, a measure of risk, is around 20%. This historical data helps investors set realistic expectations for future returns and assess the potential volatility of their investments. Moreover, investors often use risk-adjusted performance metrics to evaluate the attractiveness of different investments. One such metric is the Sharpe ratio, which measures the excess return per unit of risk. It is calculated as small text Schrack E minus RF sigma I, where is the expected return of the investment, is the risk-free rate, and is the standard deviation of the investment's returns. A higher Sharpe ratio indicates a more attractive investment, as it offers higher returns for a given level of risk. In addition to the Sharpe ratio, the Sortino ratio is another risk-adjusted performance metric that focuses on downside risk. Unlike the Sharpe ratio, which considers both upside and downside volatility, the Sortino ratio only penalizes investments for negative returns. This makes it particularly useful for investors who are primarily concerned with minimizing losses. The Sortino ratio is calculated as Sortino ratio E minus RF sigma D, where is the standard deviation of the negative returns. A higher Sortino ratio indicates a more favorable risk-return profile, as it reflects higher returns relative to downside risk. Understanding risk and return also requires consideration of behavioral finance, which examines how psychological factors influence investment decisions. Behavioral biases such as overconfidence, loss aversion, and herd behavior can lead to suboptimal investment choices and impact the risk-return trade-off. For instance, overconfident investors may underestimate risks and overestimate potential returns, leading to excessive risk-taking. Similarly, loss-averse investors may avoid taking necessary risks, resulting in lower returns. To mitigate the impact of behavioral biases, investors can adopt strategies such as setting predefined investment criteria, diversifying their portfolios, and seeking advice from financial professionals. Additionally, staying informed about market trends and continuously reviewing investment performance can help investors make more rational and informed decisions. In conclusion, understanding risk and return is essential for effective capital allocation and investment decision-making. By analyzing the relationship between risk and return, investors can construct diversified portfolios that maximize returns while minimizing risks. Utilizing models like the CAPM and risk-adjusted performance metrics, such as the Sharpe and Sortino ratios, enables investors to evaluate the attractiveness of different investment opportunities. Furthermore, being aware of behavioral biases and adopting strategies to mitigate their impact can enhance the overall investment process. Mastering these concepts equips investors with the knowledge and tools needed to navigate the complexities of the financial markets and achieve their investment objectives. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.